welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Chet Cowart. I am a certified financial fiduciary here at Nelson Financial Planning. Got Kristin Castello here with me, a certified financial planner, certified financial fiduciary, CPA as well. Got all the letters. We are Central Florida's longest running radio program, coming to you on a host of radio stations throughout Central Florida. Also one of the top 25 financial planning podcasts on the World Wide Web with over 47,000 downloads of our program. So welcome to the show, everybody. Hope your week went well. We have got a lot of things to cover today.
Yeah, Chet, I mean, a lot about 401ks. This has been a hot topic recently just because there's some new legislation out. A lot of people are either changing jobs or retiring. So we've had a lot of questions about what to do with my 401k. So we're going to answer a lot of those questions on today's show.
Absolutely. Yep. There's a lot of moving parts with the plans, and the rules are always changing. So important to keep everybody up to speed.
Yeah, and can you believe it? It's the end of summer. That kind of flew by.
Yeah, it flew by really fast. And I love summer. Everything I enjoy doing is outdoor related. So, I love the fall as well, but kind of sad to see summer go, although it's nice to have the weather cooling down. I actually was wearing a hoodie this morning, which is kind of crazy. It feels a little early. So, yeah, it's been nice.
Mm-hmm. Yeah. And then it's also your birthday coming up. So happy early birthday, Chet.
This is true. My birthday is October 11th. Still a young buck a little bit, but I'm starting to feel it in my knees. So, I'm not too old yet. I'm creeping up on 30, but it's okay. We got some time left.
Yeah. Also, in other news, it is World Financial Planning Day on October 8th. So that is coming up this week, too.
Yep.
Makes sense because, I mean, the S&P 500 is hitting some all-time highs right now. So just good timing overall.
Yeah. No, the market's doing extremely well. Obviously, we had some volatility earlier on in the year around the Liberation Day, I think it was called. But that seems to have subsided. And yeah, markets are at all-time highs. I think that's welcome news for everyone. I'm certainly happy about it, and I hope it continues.
Definitely. So on this week's show, we're going to dive into a lot about 401k related subjects. I really think this is going to impact a lot of our listeners, young and old. A lot of people have 401ks through their employers, or, you've got some old 401ks that you're looking to consolidate. So we're going to go into all of that on today's show. Yep.
Yeah, absolutely. Our first sort of topic on these 401k plans, the current administration is attempting to bring quote unquote alternative investments as a available option in the plan. So things like private equity, cryptocurrencies, those are all things that are it's going to be attempted to bring them into the plans. Whether that happens or not is to be seen.
And then we're also going to talk about a major tax break that high earners age 50 and older are about to lose on their 401k contribution starting in 2026. So if you are 50 or turning 50 next year, pay attention. This may be applicable to you.
Absolutely. And we're going to go over, some common questions that we hear pretty much on a day-to-day basis from our clients involving just what do you do with your 401k, whether that be you're currently contributing to one and working a job that provides you one. Maybe you have moved jobs and you have an old one that has sort of been left behind, or maybe you are about to retire or have just retired and you have a plan from your work and you're wondering, what do I do with it? So we're going to go over some of those topics as well.
Yeah. So first off, we're going to go into the alternative investments. So Chet, what do you think about this topic?
Yeah, I mean, I think it's interesting, for the majority of time, the investments available to you in these 401k plans have been, I'll say boring, quote unquote. But for good reason. I think things like mutual funds that own big blue chip companies, ETFs that track indexes, target date funds. And that's been the bread and butter of these plans. They're stable and reliable and proven. So that's, that's what we know. Those will, I think, always be around. But the goal of the current administration is to bring some new options for people.
Right. So like you said, a lot of people find, the typical investments that have been proven over time to be quote unquote boring. But it looks like there's going to be some changes with the current administration's recent actions. So they're talking about potentially offering some new investment options within the 401ks, right?
Yep. Yeah. So there was a executive order signed. It directs the Labor Department to help stop some of the regulation, they say burdensome lawsuits that come out of bringing some of these alternative investments into these plans. So I assume you saw that.
Mm-hmm. Yeah. There's been massive lawsuits against 401ks in the past just because of potentially higher fees that some of the employers were kind of putting into these 401k options, as well as they may have been too aggressive or not aggressive enough. So there's just been massive lawsuits. So I can understand why some 401k providers are a little hesitant to offer these alternative investments, because they are probably going to be on the more expensive side, the more risky side. So the litigation is certainly a reason to kind of avoid these alternative investments.
Right. Yeah, it's a legal issue and it's not a legal issue because the issue is the litigation involving the plan participants suing the employers and the custodians of the plan. So there's no law saying that there can't be alternative investments in the plan. It's more so just that in the past, if the fees are deemed excessively high, then companies have been sued for that. So, I think whether or not this actually comes to fruition is not so much going to be a legal issue involving whether or not they are allowed. It's more so going to be, do employers want to take the risk, I guess.
Right. And I mean, I get it. There's a lot of cool investments out there, and they're on the rise right now. So you can see how some of your friends or colleagues or just people on the internet have made a lot of money in this one particular investment. And you're like, oh, hey, well, maybe I want that in my 401k. So I see why there's the want for it, but maybe it's not necessarily the best suitable investment for a lot of our investors out there.
Absolutely. And there have been you mentioned the big settlements in the past, Boeing, Lockheed. This certainly happened before, so there is a precedent in terms of employers or employees, suing their employers regarding what kind of investments are offered in the plan. So it'll be interesting to see kind of if this becomes a reality or not. I understand why people do want them, because it's these private investments, private equity, crypto, things like that. They're kind of seen as the investments of the rich and powerful, and this is how you make all of your money. And the vanilla, index tracking investments are not going to bring you outsized gains. And I guess in some cases that may be true, but the grass isn't necessarily always greener on the other side with that kind of thing.
Yeah. I mean, a few weeks ago, didn't you talk to Joel about something about this? He had a private fund that buys real estate, and he owned that, and he was thinking he was getting some returns on it, but it actually turned out to be a different story.
Yeah, absolutely. So this was some of you may remember, because this was on a radio show me and Joel did a few months ago, but he invested in a private equity fund that buys real estate, and he did it more so because he wanted to have some experience in the matter before kind of talking about it with clients. We get asked about this stuff relatively often. So essentially, long story short, the IRR, the internal rate of return of the fund, was advertised as over 10%. That essentially is saying what the assets are returning within the fund. But then at the end of the day, when it came down to the investor rate of return, which is after all expenses and fees, that was closer to 5%. So that kind of shows the underlying issue with these private equity placements, that sort of thing, is that while they may perform really well internally, what you actually net as the investor may not be what you think it's going to be.
Exactly. Yes. And that's a really, really important point, is that sometimes the numbers look great on paper, and sometimes they're going to be boasting that internal rate of return. Like you said there, for that investment was 10%, but the actual rate of return was much lower, was half of that at 5%.
Right.
So while the numbers may look great, really need to take into account fees, expenses, and what really matters is what ends up in your pocket at the end of the day.
Right.
Welcome back to the program. This is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. So my name is Kristin and Castello. I am joined here with Chet Cowart. Before the break, we were talking about alternative investments that are now going to be potentially available within your 401k options. So Chet, kind of recap us on the investment that Joel had made that you talked about on a previous show.
Yeah, so long story short, the current administration has signed an executive order. Basically what they're trying to do is bring alternative investments as available options in your employer retirement plan. So think private equity, cryptocurrency, that sort of thing. I think people have been asking for this for a long time. Those investments are seen as sort of the the investments for the wealthy, the powerful, what can beat the market, maybe what can just offer you outsized returns, and in some cases that can be true. Obviously everything is a risk reward argument. The potential for huge returns are there, but that isn't always the case, and a good way to highlight that is a story from Joel himself. So this was actually a few years ago when he did it, but we talked about it on the show a few months ago. Essentially what he did was he invested a sum of money into a private equity fund that invests in real estate. And the reason was because the advertisement said that the internal rate of return was well over 10% over a long-term basis. So that sounds really good. But we have to remember, IRR, that means internal rate of return. That is what the assets within the fund return on a pre-fee, pre-expense basis. And then at the end of the day, what really happened is when we calculated his personal return after all of those fees and expenses, that happened to be closer to about 5%. So that ends up being the issue, is that with these private funds, the expenses are a lot higher because there's a lot more active trading. You have to pay managers a little bit more because they're a little bit more hands-on. So yeah, I mean, that I guess is the fear here, is that when and if those investments become options in your 401k, it may drag performance, it may cause liquidity issues to the investor. And, I think it is important to also think who is passing these rules and trying to get this, get this into your plan. You got to think what their motivation may be. I think for these managers, more retail money and more liquidity in their funds, that's obviously what they're going to want. They want more retail money into their investments. So it may not be in your best interest. It may be in the fund manager's best interest.
Yeah, and I mean, after hearing that about Joel's experience, I think it's safe to say that we won't really be recommending any types of alternative investments anytime soon. Over here at our firm, at Nelson Financial Planning, we are definitely fans, of what we've seen work over long periods of time. So we only use funds with at least a 20-year track record because that shows reliability and consistency.
Yeah, no, absolutely. That's always been kind of our consensus, is use funds with a long-term track record, 20 years or more, in terms of performance metrics that we can look at and judge the fund based off of, as well as, we only recommend funds that we invest in ourselves as individuals and as a firm. So all of the funds that you guys, as our clients, will see in your portfolios are funds that we personally use as well for our retirement accounts.
Yeah, I think that's really important.
Yeah, no, absolutely. It kind of shows that, we believe what we're saying. We're putting our money where our mouth is, so to speak. So yeah.
Yeah. So if you have any questions about your 401k, or maybe you have the option to add in these alternative investments coming up, just give us a call. We offer free initial consultations. We're happy to take a look at those options within your 401k and just give some advice, some perspective into what may benefit you.
Right. So for the back half of this segment and into the next one, we're going to be talking about some changes coming to these 401k plans in terms of their catch-up contributions. So there's some big changes coming, especially if you are a high earner over the age of 50. So some background for our listeners: 401ks typically their contribution limit is $23,500, but they offer catch-up contributions for those age 50 and older. Those that amounts to $7,500 extra on a yearly basis. So previously, employees have the option to do pre-tax or Roth for their $7,500 catch-up contribution. And if you are age 60 to 63, which is a new rule, there's a super catch-up that increases that amount to $11,250. But now there's a new regulation. Have you heard about the new Roth rule?
Yep. There's been a lot of articles out there about it, a lot of news about it. It's causing quite a stir. It's actually not that new because it originated from the Secure Act passed back in 2022. But as always, the IRS took their time to finalize the rules on it. So it is just starting up in 2026. So what the new rule is if you are 50 and older and you are earning more than $145,000 of wages at your employer, your catch-up contributions to your 401k will have to be made into a Roth account. So that means you're going to be paying the taxes up front on those. So you won't be able to do your catch-up contributions as a pre-tax contribution anymore. So that's that $7,500 if you're age 50 and older, and then if you fall in that special catch-up bracket of ages 60 to 63, that amounts to $11,250.
So the IRS is mandating Roth savings, which means they get their cut up front. I'm not totally surprised by that, that they would want that. So what does this mean, for our clients and their strategy when it comes to retirement savings?
Great question. That's the question everybody wants answered. So the IRS just finished the rules, and for some, this is going to be a major shift. So imagine if you're 60, so you fall into that super catch-up bracket, and you are in the 35% bracket or potentially the 37% bracket, and you want to make a super catch-up contribution of that $11,250, you could lose a $4,000 tax benefit. So that's just taking the $11,250 times your tax bracket of 35%. That's a $4,000 difference. So that's pretty significant. And even with the contribution being Roth, that doesn't lower your income for tax purposes. So that could push your adjusted gross income into a higher tax bracket.
Right.
So some major implications from it if you don't kind of just take a look at it and plan ahead.
Yeah, no, that's definitely something to keep your eye on, especially if you're right on the cusp of another tax bracket. As we just talked about, the Roth contributions don't bring your income down on an immediate basis like the traditional contributions do. So there's a problem here because I see a lot of clients I talk to look at their 401k plans. They don't have a Roth option. So if that's the case, then what happens there?
That's a real possibility. So 401k plans are not required to offer the Roth option, though many are, just by virtue of it's a popular option. A lot of people want to do the Roth, so a lot of 401k plans are offering it now. But if your plan doesn't have a Roth option, you may not be able to do catch-up contributions at all if you fall into that high wage earner.
Mm-hmm. Yeah, I have seen more and more Roth options in plans recently just due to the popularity, but I still on a relatively regular basis, see that as not an option. So that I would imagine this is going to push more employers to add the Roth option, right? It has to.
Oh, I'm sure. When high income earners are going to be shut out of their catch-up contributions in 2026, they'll complain, and I'm sure more plans will start offering that Roth option.
So if you're a self-employed high earner, what does this look like?
Yeah, so it turns out self-employed individuals are exempt from the new mandatory Roth catch-up for high earners. So this means if you own your own business and you are set up as like an S corporation or something along those lines where you're paying yourself wages and you establish a 401k for your business, so something like a solo 401k, you can continue making pre-tax catch-up contributions. So you are not required to make those catch-up contributions as Roth.
And who else is exempt?
Well, so there's another category that's sort of exempt. So the way that the wage limit works is it looks back at the previous year that you worked at that same employer. So if you are new at your job, that first year will kind of be a free pass for the Roth rule. So since we're looking back at the prior year wages, that means that technically the new employees can get a free pass for their first year.
So there's some exemptions, and there's some people that that may get screwed on this, we will certainly see. But we're going to dive a little bit more into this, as well as some options of what you can do with your 401k plan, whether you're still working or nearing retirement or even in retirement. So this has been Chet Cowart, Certified Financial Fiduciary with Nelson Financial Planning. Kristin Castello, also Certified Financial Fiduciary. We will be right back.
So before the break, we were talking about potentially new employers or new employees being exempt from the Roth option or the Roth requirement for catch-up contributions. So what that kind of looks like is if you are a high income earner, which is classified as making $145,000 of wages at your employer, then you are required to make your catch-up contributions as Roth contributions. Mm-hmm. So before you had the option to do pre-tax or Roth, but going into 2026, if you fall into that high income category of $145,000 or higher, then you will be required to make those catch-up contributions as Roth contributions. So there was an exempt category, so self-employed individuals that have a solo 401k or something along those lines. Those individuals are exempt from this Roth requirement. And then in a way, new employees are also exempt because the way that the wage limitation works is that it looks at the previous year. So if you were a new employee and you don't have a previous year to look back on, then you can do some pre-tax catch-up contributions. So remember, catch-up contributions apply if you're age 50 and older, and then there's a super catch-up that is $11,250 if you fall between the ages of 60 and 63.
Sounds like the IRS wants their money now and not later.
Exactly. There's been a huge push for Roth, so that's what they're looking for, is that tax revenue.
Yeah, I have heard we have a little bit of a debt issue in this country. So it seems that's coming to a head. But that last exemption, makes sense. You can't really have a prior year wage at a job that you just started, So I know there's a lot of chatter about this, but is the Roth really a bad deal, or could it actually help some savers in the long run? Because I know we, on a regular basis, recommend Roth IRAs for clients, so they can't be that bad, right?
Oh, yeah. I mean, that is a very popular question. And I mean, this is one of those, there's no right answer. So there's not a one-size-fits-all response to this. So really, everybody's tax situation is going to be different. So while a lot of people love the upfront tax deduction of a traditional 401k, some say that Roth could be the ultimate winner in the long run because you're paying the taxes now, but in the future, your withdrawals are going to be tax-free. So what we do here over at Nelson Financial Planning is our team of certified financial fiduciaries, along with our tax department, do this sort of analysis all the time for our clients. In fact, I just did a pre-tax versus Roth comparison for one of our clients, and we ultimately decided that splitting his 401 contributions 50-50 between pre-tax and Roth made the most sense, because then you're getting that tax-free benefit, but then you're also getting the offsetting current tax deduction. So in some cases, we recommend clients do 100% Roth, and for others, we recommend 100% pre-tax. So it really, really does depend on each specific person and their financial picture, as well as their other assets. So for example, we just had a client who inherited a large Roth IRA. So in her case, doing pre-tax was the better option because she already had so much Roth savings. And so the Roth IRA will keep her in a low tax bracket when she eventually retires, because all that money will come out tax-free. But by doing the pre-tax contributions now, she's able to save on the taxes and still stay in a lower tax bracket.
Yep. Yeah, I mean, obviously, the classic advice is if you're young, low-income earner, go Roth. If you're older, higher-income earner, go traditional to bring that income down. But it's obviously a lot more nuanced than that, and we never know where tax rates are going to go as well. So that's certainly a part of it. But there's a lot of flexibility with what employers can choose to do with their contributions. Yeah, obviously you can mix and match. You can do one or the other at various different percentages. So does this new Roth rule have you questioning your retirement strategy? Well, give us a call, 407-629-6477. Check out our website, nelsonfinancialplanning.com. Schedule a conversation with us. They're, of course, always free with one of our certified financial fiduciaries, such as me and Kristin.
Yeah. So then, so that's all the updates on the catch-up contributions. So now we're going to kind of segue into our last topic here, which is about consolidating your retirement accounts.
Right.
So we've been hearing this a lot from our clients and prospects and just, people kind of calling in and asking questions is, should I consolidate my retirement accounts?
Yep, there's a lot of different reasons why you would or would not. There's a ton of moving parts. Consolidating them, there's a lot of good reasons to do that. Some of those are, just simplifying your finances as plain as that is. Just having all of your retirement accounts in one place, in one account, under one account number, that makes things a lot more simple. You'd be surprised, although maybe many of you guys have experienced this as well in your own life. You have accounts everywhere and you don't know really what's going on with any of them. It's hard to keep up with them. So that is a big reason, as well as cutting down on fees. Oftentimes you can get a lower fee structure when you have all of your assets in one place and meet a certain break point. The expenses become a lot lower, as well as the obvious one is opening up your investment options. So if any of you guys listening open up maybe you go on your online portal, open up your 401k, and you look at kind of what's available to you. Typically, it's only 10, 15, maybe 20 funds, and out of those possible 20, then 8 of them are going to be target date funds. So, with an IRA, you get to pick from the entire universe of mutual funds, ETFs, single stocks, really whatever you want. So it brings opens a lot of doors for you.
Yeah. And one other benefit would be if you are in retirement and you're over age 73 and you are starting your required minimum distributions, if your accounts are kind of all over the place, that calculation can be pretty difficult because you're calculating based on the ending balance of each and every one of those accounts.
Right.
So just something else to keep in mind, if you are approaching that RMD age, required minimum distribution, could make sense to put it all in one place just to make that calculation a little bit easier.
Yeah. That makes things a lot simpler. I can tell you, calculating RMDs when it's when there's 5 accounts in different places and you can't get a year-end statement from wherever they are, that certainly makes things difficult. So I mean, with consolidation seeming like a great option, there's some basics there. So, to move your retirement accounts, you have 2 options. You have a direct rollover and you have a 60-day rollover. So, can you go a little bit into detail on what the differences are between those?
Yep. So with a direct transfer or a direct rollover, your money moves electronically from one institution to the other. So there's no hands-on involvement on your part. So sometimes it's even a paper check that's issued to the new institution, but it's made out directly to that new institution. So that is still considered a direct transfer or a direct rollover. So then with the 60-day indirect rollover, you actually withdraw the money from the account, put it in your own personal account, or you get a check made out to you, and then you have 60 days to put it into another qualified account. So this could be another 401k, IRA, 403b, any sort of qualified retirement account like that. The main thing about these 60-day rollovers is that 60 days is a hard number. So if you miss that deadline, you could face some heavy tax implications. And if you're under age 59 and a half, there's a 10% early withdrawal penalty unless you qualify for one of the exceptions.
Right. It seems risky to go with that option to me. Why would anybody do that? There's got to be a reason.
Yeah, I mean, so sometimes people need temporary access to their money. So maybe for a down payment on a home or an emergency expense that came up. So, hurricanes come through, new roofs, something along those lines. If you can return the money within 60 days, you avoid all penalties and taxes. So it's a pretty good option if you just need quick money and you're going to replace the funds. So we've seen 60-day rollovers work when it's also too hard to do the direct rollover. So for example, you have a small account at a company that is either difficult to work with, you can't get a hold of them, maybe they're a small office in a different state and you can't figure out the paperwork, or you just can't get it to logistically work. You can withdraw 100% of your balance and then you have 60 days to move it into that new account.
Yeah, I mean, in our experience here at the office, we've seen that many times. I mean, not only that difficulty with dealing with the employer, oftentimes it's easier to just pull it out, but also things like using the money as a down payment for a house, and then while you sell your old house and you sell it and you roll it back in. So there's certainly some reason to do it. The big difference is that you can only do one 60-day rollover every 12 months, no matter how many IRAs you have. And then with a direct rollover, there's no limit, so you do have to be careful with that. But we're going to go a little bit more into detail on some of this stuff, as well as recap the show. So we'll certainly be right back. This has been Chet with Nelson Financial Planning, certified financial fiduciary, as well as Kristin, also a certified financial fiduciary. Stay tuned. We will be right back. We were talking a lot about 401ks today. The last segment we were, talking about sort of what to do with your plan and what kind of options you have in terms of moving it and consolidating it. So, kind of where do we leave off there?
Yeah. So we were saying that consolidating your retirement accounts can really help simplify your finances. It can cut down on your fees. It can also open up some new investment options, as well as make that required minimum distribution calculation just a little bit easier once you hit age 73. So we are also talking about how you go about consolidating these accounts. So you have two options. There is a direct transfer or a 60-day rollover. So we were talking right before the break about how you can only do one 60-day rollover every 12 months, whereas with direct transfers, you can do them. There's no limit on that. But what happens if you miss the 60-day rollover deadline? So is there any relief for that? So that is where things get a little bit interesting. So since 2016, the IRS allows for self-certification. This actually happens on your tax return. There's a form for this. So if your rollover is late due to, there's some exemptions. So some of the 12 reasons would be illness, a family death, bank error, even postal delays. We probably saw a lot of those during the COVID times. So you can actually submit a letter to the IRS to see if you can avoid some interest and penalties if you do miss that 60-day deadline.
Right.
But beware, the IRS can still reject your explanation if it doesn't meet their standards or their qualifications. So this could mean you would owe income taxes on that rollover amount and potentially 10% penalty, early withdrawal penalty, if you're under age 59 and a half.
Yep. No, there's some ways to get around that, but be aware you are still at the mercy of the approval or denial of the IRS, and that is a scary thing. So do that carefully, tread carefully. But it is, it's a very tight deadline, and we've seen the 60-day rollover used in various circumstances. What we've seen with clients here at the firm. There's a couple of client examples that we'll go over. One I briefly mentioned in the last segment, that would be a home purchase. So if you're selling one home and purchasing another, but the closing dates don't exactly match up, so you need a down payment for the new house while the old house is not exactly sold yet, you haven't got the money in your pocket yet, you can use the balance of a retirement account to pay that, and then after your previous house sells, you can kind of roll that back in via a 60-day rollover, and the taxes will wash. So we've seen that happen here a few times.
Yeah, we've seen that quite a bit. Just because sometimes you see a house and you want to jump on it, but you haven't put your house up on the market yet. So that's usually the circumstances. And we are very strategic with our clients when it comes to that. We want to make sure that they're not going to miss that 60-day deadline. So when we are planning that out with them, we are getting it, to the day to make sure that they do not get hit with any sort of taxes or penalties.
Yep, and then we've got another example would be fraud, less of a fun example, but if you accidentally pull out a large amount from your retirement plan due to getting scammed, defrauded, that sort of thing, assuming that you catch it within 60 days, you can kind of slide that money back into your retirement account and not face the consequences of that large tax bill. Yeah.
And then another thing is just timing. So sometimes a direct transfer can take a couple weeks. So if you're going from an IRA to an IRA or something along those lines, it could take 3 or 4 weeks. Whereas if you need something to happen quickly, you could go with the 60-day indirect rollover, because you can get the money withdrawn to you. Usually takes about 2 days, and then you can immediately kind of deposit it into the new retirement account.
Yeah, and as people that work on the back end of that sort of thing really often, me and yourself, it does take a while a lot of times, and the sending company will often deny your request for, whatever reason under the sun. Oftentimes it just feels like they don't want to let the money go. But with that being said, that's a good reason for an indirect rollover, is to kind of cut out that whole entire process of their paperwork and waiting and calling them and their processing team and making sure it's happening. So there can certainly be some benefits to that option.
Right. But just remember that the indirect rollover is once a year. You can only do that one time for every rolling 12 months. So something to keep in mind. While it is a good option, it is not unlimited like the direct rollover or the direct transfers.
Yep. So it's been a full show of 401k talk. That first segment, it's exciting, and I'm curious how it will go. This is the whole alternative investments coming to 401ks. To kind of recap, the current administration has passed or signed an executive order that is supposed to reduce some of the regulation and hopefully litigation involving these types of investments being in retirement accounts. So things like private equity, cryptocurrency, they are not currently in most of the your 401k plans, but it's not technically illegal for them to be. It's more so just that the employers don't do it for fear of being sued, and the current administration is trying to put a stop to that. So we'll see how that goes.
It'll be interesting, to say the least. We'll see. The other thing that we talked about was a big change to your 401k catch-up contributions for if you were age 50 and older. So if you are a high income earner, so that qualifies if you make $145,000 as your salary or higher, your catch-up contributions have to be Roth starting in 2026. So we get it. This is going to mean that you are losing out on a major tax deduction, especially if you are in a higher tax bracket. So we wanted to make sure that we gave you all this information ahead of time so that you can plan accordingly, maybe adjust your tax withholding or adjust your pre-tax or Roth contributions to minimize your taxes going into 2026. So thinking ahead, we're almost, 2026 is going to roll around sooner than we can imagine here. So you, just to kind of save you from a surprise tax hit when you file your 2020 taxes or 2026 taxes, give us a call, reach out to us. We're happy to take a look at your 401k contributions.
And then in terms of the plans themselves and what to do with them, you have a ton of different options. We talked a lot about the direct versus indirect rollovers in the last segment. But there's even if you're not in retirement, there's many reasons to consolidate these accounts. Speaking of in retirement, there's the obvious RMD issue where it's a lot easier to calculate and handle these things when all of the accounts are in one place. But then fees, investment options, these are all reasons to do it as well. Yeah,
and there's just two main ways that you can do those consolidations. It is a direct transfer or a 60-day indirect rollover. So we just talked about this on the previous segment. So the main benefits would be that if you are doing a direct transfer, it is hands-off for you as the client. So money goes directly into the new retirement account, no tax implications. It's a very clean transaction. Whereas with the 60-day rollover, you actually withdraw the money. It gives you flexibility, but there is a steep 10% penalty if you are under age 59 and a half and that deadline is missed, or you would be responsible for the taxes if you miss the deadline.
Well, everybody, that is all for today on Dollars and Cents with Chet Cowart and Kristin Castello of Nelson Financial Planning. If you liked what you heard and you want to learn more about how our team of certified financial fiduciaries at Nelson Financial Planning can help you change your life with a successful and cost-effective financial plan, go to our website, nelsonfinancialplanning.com, and fill out the Contact Us form to set up a free conversation, or you can call the office directly at 407-629-6477. We still have humans that answer the phone when you call. And remember, we don't ever believe in account minimums. We have no account minimums. We want to work with you wherever you are in your journey, and we pride ourselves on some pretty cost-effective fees as well. We don't ever charge for any of our conversations, and we truly just want to help in whatever way we can. That's kind of what we believe being a fiduciary means. We need to help in any way that we can.
Yep. So we appreciate you listening to the show, and enjoy the rest of your Sunday.